up, everybody? Nate here. And three major global banks, Signature Bank, Silicon Valley Bank, and now Credit Suisse, have all collapsed. This is kind of causing some major problems for central banks all throughout the world, particularly the Federal Reserve of the United States. They and the Treasury Department are now trying to pick up the pieces and figure out a plan to stop a full-on contagion. This bank crisis contagion is starting to affect many regional banks, in particular First Republic Bank, as it could be the next major bank on the verge of collapse. And with the Federal Reserve on the cusp of raising interest rates yet again tomorrow, many experts and investors are now calling on the Fed and the Treasury Department to stop raising interest rates and actually lower them because of the potential economic consequences and a full-on banking crisis. So today I want to give an update on the entire situation, starting with Credit Suisse. Now, when it comes to Credit Suisse, they have been having some pretty serious problems over the last few years, whether it be some big scandals or some liquidity issues, because some of the people who have taken on their debt haven't been able to pay back that debt. So they're defaulting, kind of leaving Credit Suisse with all of the money to pay back. Not only that, but they've taken on some pretty huge losses from their bonds. And the reason for that is because there was a lot of people starting to pull their money out of Credit Suisse. And when people were pulling their money out, Credit Suisse didn't have enough money to cover all of its uninsured and insured funds. So it wanted to start selling off its bonds in order to have the cash in order to bring liquidity back to its bank. But that also caused it to run out of money even faster. The Swiss bank actually put around $54 billion into the bank in order to give it that additional liquidity, but that was not nearly enough. It started to collapse even further as people began to have even bigger distrust in the bank. That caused everything to collapse. And now, even after a bailout, the entire bank is getting bought up by UBS. UBS bought Credit Suisse over the weekend for around $1 billion because if they didn't, it might have triggered a full-on banking crisis. Credit Suisse does a lot of business with startups. It does a lot of business with entrepreneurs and founders and a ton of other businesses and investors. And if that liquidity suddenly stops going into the market, then all of those people and all of those agencies are no longer going to have the funds they need in order to support their business or their investments. Not only that, but with people pulling their money out of the bank, now you have an entire system and everything that is connected to Credit Suisse suddenly falling over. All of the credit that it has issued, none of that would have been good anymore. So now there was all of this money getting burnt up and all of this debt that was about to be created. Now, over here in the United States, we had our own issues with banking failures. We had Silicon Valley Bank kind of fall for the same reasons as Credit Suisse, and then we also had Signature Bank, and it fell because it was heavily connected with a ton of crypto companies. Obviously, startups in the United States and cryptocurrency have all dramatically fallen over the last year or so. So these banks didn't have the liquidity they needed because all of their depositors were burning through all of their cash. That meant the bank couldn't invest as much, and when people were burning money through the bank, they now had to sell a bunch of their bonds in order to give people their money back. That kind of scared people because they saw how many losses the bank was taking on, and we had a good old-fashioned run on the bank. So now you had thousands of investors, thousands of startups and entrepreneurs pulling their money out of Signature Bank and Silicon Valley Bank. But what the Federal Reserve and the Treasury Department decided to do was very much different than the Central Bank of Switzerland. They decided not to bail the banks out, but to create a backstop. This is a little bit different because instead of using taxpayer money directly, they were actually going to issue a fee on existing banks who are part of the FDIC system. They would be issued a fee and they would essentially use those funds in order to fund the bank and all of the depositors' money. That sort of solved these banks' problems in the short term, especially now since we have regulators running the banks. But what still has to be solved is the major issue at hand, and that is Federal Reserve interest rates and the rest of our banking system. Treasury Secretary Janet Yellen actually talked about this over the weekend, saying that SVB, Silicon Valley Bank, was a very special situation, and in the future, it's not guaranteed that other banks and their uninsured deposits would be covered by the government. Basically, what happened with Silicon Valley Bank is that it had millionaires and billionaires doing business at its bank. FDIC, or the Federal Deposit Insurance Corporation, is a group of banks that pump money into a specific system, so that way, in case one bank goes under, some of the funds at that bank are covered for the depositors. So this is actually meant to cover regular everyday consumers and up to around $250,000 in cash. The problem is a lot of these banks had way more than $250,000 in cash. Around 90 to 95% of SVB's funds were in uninsured funds. So that meant that the depositors were going to lose most of their money when the bank collapsed. The government created a backstop in order to ensure that those depositors got their money back. But what if this happens again? Janet Yellen said the only way the Treasury Department or the Federal Reserve would create a backstop or bail out a bank outright is if its collapse created a massive issue for the United States economy. So if millions of people were going to lose their money or it was going to trigger a full-on banking collapse, then the government would step in some way. It's not going to do it for every bank. At least that's what she said over the weekend. Now, even more recently, Janet Yellen actually walked back a lot of those statements and said that there is a possibility that some depositors' funds would be covered in the event another massive bank fails. That sort of opens up an entire can of worms for the federal government, because the whole reasoning behind this backstop from the government in the first place was that they were going to use funds from other banks. So they weren't going to use taxpayer money in order to fund all of these failed banks. But what a lot of people don't realize is the way that banks get money. The way that banks get money and invest money and make money is through something called the fractional reserve lending system. Let's just say you take $100 and put it in the bank. Well, then the bank turns around and loans this money out to get $10,000. So they're making money on your $100. And if you go back and ask for your $100 back, they're going to give it to you because they've made $9,900 off your $100. Now imagine this on a grand scale with millions of different accounts. Now this is how banks make hundreds of billions of dollars every single year. But this becomes a problem if everybody goes to the bank all at once and gets their money out. The bank doesn't have your money anymore. It's all being held in other assets. And sure, it could sell those assets, but it might do that at a loss, which means it could have less funds to give back to everybody else, triggering a full-on banking collapse. That's why they call it the fractional reserve system, because the bank is only required to keep a fraction of all of its depositors' money on hand. It lends out the rest and makes hundreds of billions of dollars. So now, knowing that, the bank is using your money to pay for the failures of all of these other banks. But if this was to happen on a much bigger scale, that means the government is either going to have to use direct taxpayer money in a bailout, or they're going to have to create an even bigger backstop. And either way, it's going to cost you. Now, what this whole banking collapse and crisis is doing to the rest of our economy is creating a contagion that is affecting other banks and the American consumer. First Republic Bank is a regional bank that is being directly affected by this because of their connections with other banks and the way that they lend money. And now some other regional banks like Comerica Bank are also starting to have some trouble because of these larger banking failures. And it all has to do with uninsured funds. Most of these banks have a lot of uninsured funds. Like Comerica Bank has over 80% of its depositor money in uninsured funds. So if it was to collapse, it would not be able to guarantee that everybody is going to get their money back. That means that the government would have to step in, or millions of people are going to lose money. This is kind of a lose-lose situation for the government, because on one hand, they're going to use taxpayer money, which costs people a lot up front, in order to give everybody else back their money and sort of pay for the failures of these banks. They can assess a fee on the banks, but again, that's going to cost you money because you put your money in the bank and then they use that money to pay for fees, invest, save, whatever they want to do. But on the other hand, if they just let the bank fail, well, now you have startups and other businesses and consumers who can't use their money, who have saved up hundreds of thousands of dollars that they no longer have access to. That means they're not going to be able to pump that money into the economy. That means businesses are going to shut down, which means unemployment could rise pretty much immediately if the government does nothing. And that is the case for the entire globe. And the Federal Reserve's response to this is to create a dollar swap program. This ensures more liquidity and more US dollars kind of flow throughout the entire world, because what happened in 2008 when we saw Lehman Brothers collapse, the biggest banking collapse in US history, was there wasn't enough liquidity in the market for banks and other businesses to get assets in order to continue to invest and grow their company. What the Fed is doing now in response to this banking failure is they're actually trying to pump more US dollars into the system, so that way other countries can swap different currencies and different assets for US dollars. In fact, many other central banks throughout the world are doing the exact same thing in order to prevent a full-on banking crisis and supply the entire market with even more liquidity. That gives banks access to money that they can then go out and lend, because because if banks are struggling, then they're not going to want to give people loans. They're not going to want to help VCs and other startups get the money that they need to grow their business. They're going to try to hold on to as much as possible. But that also could be a problem for inflation, because now you have banks who are lending out way too much money, and it gives banks an opportunity to continue to be risky with their money and lend out even more cash, especially US dollars. And now the main thing kind of causing all of this is our entire economy starting to shrink. We had an inflation problem over the last couple of years, and we still do in the United States. And what the Federal Reserve is doing to address this is raising its interest rates. This pulls all of these US dollars out of the system. It makes demand go down, because now getting a loan is a lot harder because interest rates are higher. People can't go out and get a mortgage or a car loan or spend on credit cards as easily. That means there's less liquidity in the system in general for businesses and just for everybody, because not everybody is spending. But that also means that all of this debt and all of these investments that businesses and banks have taken on are also starting to go down in value. That is getting a whole lot more expensive. So you have businesses burning through their cash because they're having to pay so much higher fees on their debt, and then they're not bringing in as much cash because it's harder for investors to raise funds for businesses. And what you got to remember is, what do businesses do when they get this money? They put it in a bank. And the problem is they're not putting as much money in banks right now. So the entire banking system is collapsing. And how they make money is by lending out all of the money that businesses and consumers give them. Well, they're not giving them as much money. They are burning through cash because inflation is high and they can't take on as much debt. That is why many experts and investors are calling on the Federal Reserve to stop raising interest rates. And some are even saying that they should lower them starting tomorrow. Now, that would sort of help out banks and businesses because it would be easier to lend out money. That is the entire situation that a lot of these banks and businesses have lived through and have started up in since the 2008 financial crash, where low interest rates were basically the norm. There was so much money that was pumped into the system, but now it's harder to come by, and all of these assets and employees and startups that these banks have invested in, well, it has just become way too much. They've taken on way too much here, and now with everything contracting, things are starting to drop off. And while yes, that extra spending would help the entire global economy in the short term, it's also the reason we're here in the first place. With all of that extra spending and banks loaning out money like crazy again, that would make inflation go up. It would make the value of everything go up again, and that would mean that our dollars are becoming a whole lot less valuable. Other countries don't want to hold on to less valuable currency, so they're going to trade it away. That's going to be bad for our entire debt ceiling problem that we have to address by this summer. Not only that, but it would hurt Americans' buying power because now they need to make a whole lot more money, but it's hard with inflation continuing to rise, and inflation is still near a 40-year high. So it's not just an easy decision for the Federal Reserve of raising or lowering their interest rates. Every decision that they make has serious consequences. So like I said, this entire situation is a huge mess, and it could lead to a lot of businesses disappearing. It could lead to a lot more inflation. It could lead to many people being out of work. Nobody knows exactly what is going to come next, but like I said before, every decision has consequences, and you need to be prepared for what could be coming next. The best way to do that is to be financially educated. You have to know what to do with your money and when to do it. If this whole crisis turns into an outright recession or worse, then there's going to be a lot of suffering, but that doesn't mean that you necessarily have to suffer. If you are educated, then there is a potential that you could actually capitalize on a lot of the opportunities that could be coming. And no matter what, you have to stay up to date with everything that is going on in the business and financial world. That way you can make the best decisions for your money right now. One of the easiest ways to do that is through our Market Briefs newsletter. Our team puts together a free daily newsletter 7 days a week. It goes over everything in the global economy, our local economy, the stock market, and more, and you have to subscribe if you want to stay in the know. You can do that by clicking the link in this corner right here. And I'm putting out updates 7 days a week over here on this channel, breaking down everything from financial education to what's happening with jobs and AI, and of course our global economy. So if you want to stay in the know, be sure to subscribe before you go. And if you want to know even more about what's going on, I've got another video right there, so be sure to check that out as well. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.